This is a Zacks.com special report. Well, in light of recent events in the stock market, we thought we would present a special three-part viewpoint, three separate viewpoints on the market for you. The bearish, the bullish, and the balanced views, along with strategies to enact to profit from each of those views. We're going to start off the special coverage with Steve Reitmeister, who's going to take the bearish case for us. Now, if you're sitting back saying, seems a little out of character for Steve. For the last 2.5 years, Steve, you've been pretty firmly bullish on the stock market. That whole while, you talked up the concept of the muddle-through economy. I know, I was sitting right next to you when you did it.
Absolutely.
What some called the new normal at that point. So this was a profitable strategy indeed, while many others remained bearish. But then, like almost out of no place, you got bearish yourself. About the afternoon of August 2nd, if I want to put a time on it.
That's exactly when it was, yeah.
In fact, you pushed all the way to 50% short the stock market and still profited handsomely from the massive drops that came in the days that followed. But walk us through your thoughts on how you go from bullish to this new bearish stance of yours, would you?
Yeah, people who've been following me on Zacks.com over the years, I think pretty much know by now that I am a fundamental investor, that I definitely take a look at the economic data that's out there. And from that top-down fundamental approach, what the economic data tells me is where corporate earnings will be headed. If corporate earnings are headed higher, most likely the stock market will rise with it, and that's the way I played it the last 2.5 years. But the economic data has unfortunately been going the wrong direction here the last few months, and it just has me worried about the direction of corporate earnings and what that means in the stock market. And obviously, I'm not alone in that if you take a look at the drop we've had here. So really starting in May is when the data started getting soft, but people were saying, it could just be a soft patch, and I was in that camp for a while. But then really the 1-2 punch for me that put me over the edge was that last Friday in July when we got the GDP figures, and they revised the whole series of GDP numbers going back a couple of years, and it turns out the first half of the year we only grew by 0.8%. That is very anemic, okay? And then when you consider that the July numbers, okay, which for the third quarter, in particular the ISM services and ISM manufacturing numbers, were pointing to basically what we call stall speed economic growth, like zero, but with the forward-looking indicators being in negative territory. The combination of those events had me very much concerned about what GDP was going to look like going forward and earnings going forward, and I got bearish in a hurry.
Well, again, great market timing call, as it certainly paid off handsomely for you. But now the market has already shed 16+% since the recent peaks. And so some would ask you, well, isn't that enough pain? So what do you expect going forward?
Yeah. If indeed this is a recession, the unfortunate fact is that the average recession brings a stock market decline of 43% from the peaks. So if we say the recent peaks for the Dow was 12,800, that 43% decline puts it closer to about 7,300. That is a scary concept, even from where we are today after this 16% decline. So, so here again, if indeed we are rolling towards that recession, if we were at stall speed beforehand for the economy, and now let's move forward. What is the chain reaction that I'm thinking of that's going to push us, unfortunately, into a recession? So in June, July, and August, all the talk was about Armageddon.
Right.
Okay, the debt debate. Okay, both sides talked about Armageddon. The political, the media played it up, right? And so everyone was just a little more fearful. Okay, this had, not surprisingly, the July economic data just a notch lower because probably some people were holding back on some decisions. When the debt debate is over, and people now turn their focus to the economy, what do they see? They see GDP has been lowered, they see the lower ISM, and like, whoa, that's not so good. So the stock market starts coming down, and starts coming down rapidly. So you got Armageddon over here, and then a seeming Armageddon, right? That's Armageddon talk, and then a seeming Armageddon in the stock market, and it starts to have a self-fulfilling prophecy of its own. So if we were at, say, break even on GDP before these events, and now you have the stock market declining like this, how many consumers at home are saying to themselves, I'm a little uneasy about things. I'm going to hold off on that refrigerator purchase or that new car? How many businesses are holding off on upgrades to facilities, to computers, to let's not hire that person right now. I just want to wait a little bit longer. You don't need that many decisions of that negative nature to push you over the edge from 0 to negative GDP growth. Mm-hmm. But if you wait for all the dots to add up, oh, it is a recession, if you wait for all that, you'll have lost too much money in the meantime. And that is why I've been getting bearish at this stage.
All right, so clarify something for me then. Are you saying that you are 100% convinced that a recession is coming?
Yeah, absolutely not. The economics, right, is a soft science. That means it's very non-exact. And you get two economists in the room, you're going to get about 3 opinions, right?
Right.
Okay, so here, and this is about preponderance of the evidence. This is about the odds. If I were to lay odds on this, I'd say 70% likelihood that we are going to head into recession. So that's almost about a third that it's not going to turn out so bad. And that would be a muddle-through type scenario from which stocks would rise higher, okay? But if someone were to put a gun to my head right now and said, Steve, you have to choose. None of this two-handed economist stuff, okay? What's the one hand that you're going to play? And the hand I'm going to play is that I think it's unfortunately, I keep saying unfortunately because I don't want to be right, trust me, is that I think we are going to head into a recession and all the negative things that come with that for society and the stock market as well.
Well, now we've got your full flavor for your market outlook.
Yeah.
So, unfortunately, based on that, what is your strategy then to profit in a bearish environment?
Yeah, and I thought about that, and really I got 2 different strategies because not everyone is going to be as aggressive as I like to be. So I came up with a what I'm calling the safe strategy. It's a blending of these 4 elements. We're going to have a defensive blend of stocks, cash, gold, and then inverse ETFs. So let me go into each one just a little bit. When I say defensive stocks, I think most people know what I mean, like bluest of blue chip stocks, large cap companies with solid earnings, but that are not economically sensitive. Things that are in foods, consumer staples, utilities, medical, things of that nature. And in particular, if they have large dividends. A lot of stocks after this decline, they had a 2% or 3% dividend before, now up to 3 and 4% dividend yields. That's very attractive, okay, at trying times like these. So those are the stocks you're going to want to hold on to. Cash, 20-30% cash is not crazy if the market indeed is going to be going down. Having gold, times of crisis, good for gold. But too many people think that's a reason to buy the gold miners. Unfortunately, too much of their positions are hedged, so meaning that they really don't get the full benefit of rising gold prices. I want people to own physical gold through things such as gold ETFs like GLD or GDP. Finally, inverse ETFs. These vehicles will rise as the market falls. I put up 3 of the most popular ones up on the board here. And you could go with all kinds of different inverse ETFs, but these are your garden variety ones. Now, I know some people are going to say, hey, we're long the market over here and short the market over here. Don't they balance each other out? And the answer is they do a little bit, but not perfectly. What you're doing is you're going long the stocks that will survive the best. They will outperform the market. And then you're shorting the general market. What you're going to do is you're going to create a spread in between the two that is going to create a positive return no matter how bad the market goes down. Then you add in your profits from gold and cash, and that's a lot better than the potential decline that could come from the recession.
You mentioned there were 2 ways to go.
Yeah.
What's the other way?
Yeah, the other way is a bit more aggressive, and all I have to really do is cross off that first item, which is defensive stocks. The fact is, you roll back to 2008, 2009, even the most defensive stocks got kicked in the teeth, right? So if everything's going to be going down, perhaps, and this is the strategy I like best, is perhaps no long stock positions, and you stay strictly short the stock market through the inverse ETFs, and now you're trying to profit from the market going lower. This is what I did starting in October 2008, and it helped me, make serious profits as the market tumbled down from that Great Recession. And it's quite an odd feeling to be making money while the market's going down, but it's a feeling that you can get used to. Yeah.
Well, yeah, hopefully. We appreciate your bearish strategy. Bearish as it is?
Yeah, don't want to be, but that's what the cards are telling me.
All
Yeah.
right, thanks, Steve. We appreciate it. Be sure to watch the other 2 videos in this 3-part series on the bullish and balanced strategies. Those are the 2 remaining that we have yet to talk about. Then determine which one suits you. Now, if it's Steve's here, the bearish, then continue to get his insights through the Reitmeister Trading Alert at zacks.com/RTA. Or you can follow all of our experts and their strategies with Zacks Ultimate. You can learn more about Zacks Ultimate at zacks.com/ultimate. Makes sense. With Steve Reitmeister, I'm Terry Ruffalo.